Welcome back to Palisade Radio. I'm your host, Tom Wadsworth, and joining me today is Kevin Wadsworth, or better known as North Star on Twitter. How are you today, Kevin?
Great, Tom. Thanks for having me on.
Always excellent to have you. And today we're going to try something a little different. We're going to share your screen and have a little bit more of some interactive charts. So you have a couple charts lined up for us, and we're going to start with the dollar, correct?
Yeah, good. Okay. Well, this is the dollar chart, and this is the 1 minute chart. So I've been following the price action of the dollar quite closely over the last 2 or 3 days. Well, I've been following it fairly closely for some time, of course, but over the last few days in particular, as the dollar turned down fairly significantly and has moved sharply lower down towards the 93 area. It's a very key area around 93 on the dollar index. There's some horizontal support in that area, so it's not surprising that the price came down to that sort of level and then showed some resilience. And it wasn't clear initially whether this bounce was just going to be a bit of a sort of a dead cat bounce in an ongoing developing sort of bear market in the dollar. But over the last sort of 24 hours, or 12 to 18 hours really, the dollar has started to show some more bullish signs. So the smaller patterns that make out, or that sort of build out over time, have slowly turned from bearish to bullish. So you can see these sort of bullish descending wedge patterns forming, and there was a gap there as price jumped up and hit this upper trend line. Started to turn back down again, and started getting me thinking that perhaps we're just going to sort of dive off the bottom of the chart here again and resume the plunge. But we started to build out what I sort of pretty quickly spotted, those of you that follow me on Twitter, as the potential inverse head and shoulders pattern. I struggle a bit with these head and shoulders patterns sometimes. Sometimes they work, sometimes they don't. But if you combine them with other charting techniques, like very obvious ones like putting support and resistance lines on, it helps to give you a little bit of a steer. And obviously I've got one of the indicators on here, the moving average convergence and divergence indicator, and you can sometimes pick up some hints from differing indicators as well. But after the sort of possible inverse head and shoulders pattern, we started to sort of build some possible bullish signals. This sort of red zone here is another horizontal area of sort of support and resistance, historical support and resistance, that stretches from around about 92.8 or thereabouts up to around about 93. So there's sort of a fairly thin zone of sort of support and resistance. So I was expecting price to sort of struggle a little bit as it gets into this area and then make a decision one way or the other, either down or up. So I'm continuing to track that, but the signs are, well, mixed at best. During this period here, we're showing some good sort of indications of a bullish upward trend developing with successive bullish descending wedge patterns. There's one here, then you go up, another descending bullish wedge here, which comes down to support and then takes off, and then it retraces a little bit. You get another bullish sort of wedge pattern, you break out. But instead of continuing upwards, as per my arrow here, which is what I was suggesting may well happen, price turned down, broke through one of the trend lines, and it is struggling in this sort of red zone that I've highlighted. So I'm not any sort of guru with these things. I can't do any more than monitor the support and resistance lines and just call it when we get a significant decision one way or the other, which we haven't had yet. The dollar index is still struggling to gain momentum. For other reasons and for reasons of evidence gathering, my feeling at the moment is that the dollar will manage to gain some footing here and continue to move slowly upwards. I suspect in fact, if I zoom out on the chart here and look at the 1 year time frame, you can see that all of this price action down in the bottom right hand corner, if I move my name out of the way, price action down in the bottom right hand corner has been indicative of price sort of slipping away and dropping away from this resistance line. This is actually, if I just get rid of the log view and go onto the arithmetic chart or the linear chart, there's no need to show a log chart when you're looking at indexes, because an index shouldn't behave logarithmically. It should sort of behave in a linear fashion. It shouldn't rise or fall in a logarithmic fashion. So hence the non-log chart. Over short time scales, though, it doesn't really make any difference. But when you're looking at a bigger time frame, it makes more of a difference. But this resistance line is fairly clear to see from the recent highs at around 103 as we've been dropping away. And if you go back and look at the previous sort of dollar cycle topping formation, something very similar happened, and eventually the dollar index gave up and fell away from this resistance line. When that happened, though, it initially pushed through and moved up towards the sort of higher resistance levels. I think it was the 200-day moving average, which is currently somewhere, I think, around about 96. I could put it on this chart here, but it'll probably, I'll tell you what, shall I have a go at putting it on? Let's have a little look. So if I get rid of this, some live charting for you, trying to sort of give you an indication of what it is I'm looking at. So we'll go down to the moving average, and we'll just quickly put the moving average on for you. That one there. Okay, there's your moving average, and if I select the right time frame, we'll put 200 days on here. So get rid of that. 200 days. There we go. So your 200-day moving average is descending at the moment. It's coming down slowly because obviously the index has been coming down. And if we were to turn up, my suspicion is that the 200-day moving average, this black line here, which is a historical support and resistance line, it all sort of coincides somewhere, well, somewhere around about early November. And we all know what's happening in early November. So these things don't sort of happen for coincidence. It seems like a coincidence sometimes, but sort of stuff that's going on in the real world often coincides with stuff that's going on the technical charts as well. So I don't see that as coincidence. I see that as as a sort of a good, strong indication that we're going to see a convergence of points of attraction here, moving average, resistance line, and also what happened historically the last time we were in a decline of the dollar index. So if the historical precedents are followed and the price action follows a similar path, then I think basically we're going to sort of converge somewhere around this 96 area. Technically, we could move up to the top of the arc. And if I zoom right out, you can see what I mean by the arc. It's this topping formation that I've been showing on my dollar charts for a while. Is the US dollar domed or doomed? You can see a series of cyclical dollar lows and highs on here, and the latest one has been playing out over recent years. I've been speculatively posting this domed dollar top for a couple of years now, and I think it's starting to look a little bit more realistic. A lot of skepticism to begin with, but I think history is showing some very strong signs of repeating here. And the last dollar cycle low was in sort of around about 2008 there. Interesting to note that gold didn't peak when the dollar bottomed. Of course, gold peaked in 2011 at this higher low for the US dollar. So should the US dollar reach its cyclical low, when I think it might, in a year or two's time, that's not sort of when I'm expecting gold to peak. You follow sort of 3 or 4 years after that, the gold could easily peak in the sort of late 2020s. So, at least after 2025, 2026 anyway. So I'll look at that in more detail at a later point, but you can see what I'm getting at here, this support line on here, which is very similar to one that we had back here in the last US dollar cycle. We saw the dollar index trying to cling to that line, and then it gave up and just, succumbed to gravity, if you want to call it that, succumbed to the pull of the dollar cycle. So that's my thesis. There are plenty of people who believe the opposite, and the opposite could always happen, of course, but this is what I see as the most likely scenario. So if we then move on to look at Kevin, how gold has been...
Before we move on, is there any value... I know a lot of times we look at the moving averages. And I just wanted to know if there's any merit to looking at, let's say, contrasting the 50-day or 20-day versus the 200-day on that chart.
Yeah, so I'll tell you what I do, and everyone's got a different way of using moving averages. Depending on the time frame that you're looking at, you want to, it's a different moving average that's going to be applicable to a different time frame. So if I was looking at, if I go back to the 1 year chart on here and expand it a bit so you can see what I'm looking at. So if you're trying to sort of find a moving average that is likely to provide some support, what you'll do is that you'll go back in history to a similar point in history and see which moving average was providing support and resistance. So going back all the way to the previous dollar topping period, it was the 200-day moving average that was playing a pivotal role. And over a short period of time, if you're if I just slide it across to the right a little bit here, when we're in a sort of a bullish trend. Okay, so if you're wanting to sort of find a moving average that is going to provide useful guidance, I'll simply go into the moving average length here and fiddle around with the moving average length until I find a moving average that is supporting the price in the way that it has some meaning. So you can see here the price is sort of bouncing off the moving average, as the moving average is around about 200 to 210 days, something like that. And it doesn't have to be exactly the 200-day moving average. You can play around with those numbers with whether it's gold or silver or whatever market it is that you're looking at. And I'll show you that in a moment with a gold chart and what I mean. It's particularly useful with a gold chart. So I'll, if it's okay, Tom, I'll go on to that and show you the moving average and how I use it on there. So this is how gold price, my version of how I see gold price has been responding over the last few months since the August peak. So when price peaked in August, I was tweeting that a pullback was highly likely, completely unable to sort of give any detailed guidance as to how far that pullback would go, or how deep it would be, and the time period involved. But once we got this drop here and then price rebounded, it was possible to start theorizing about the shape of the chart formation that would control the price. And in an ongoing bull market, you very often find either a bullish descending wedge or a bullish sort of descending channel of some sort that contains the price action until you reach a significant price point. And when I say significant price point, it could be a Fibonacci retracement level, it could be a moving average, it could be the support line on the chart. And when I'm looking at all of these things on the chart, I'll have multiple layers on the chart showing all of those things, the Fibonacci levels, the support and resistance lines, all that kind of stuff. But when I then sort of transfer it onto Twitter, for example, I do my best to try and keep the charts as clear and easy to understand as possible. So I very often sort of focus on one piece of evidence, one bit of the jigsaw puzzle, just so the person that's reading the tweets, even if they're not very familiar with technical chart analysis, can get a good idea of what it is I'm trying to say. It's no good having a really good prediction and a really good forecast if you kind of make it overcomplicated so that the person that's looking at the chart doesn't know what you're talking about. So this particular chart, it shows a fairly small number of the sort of resistance lines that we're interested in. The first one that became apparent was this dotted one that a lot of people sort of jumped on as being the important resistance line as we started to get into this sort of recent bit of price action here, because price bounced off it and went down, and then bounced off it again and went down, and it looked as though we were breaking out. But and also, if you put this other solid black line on here as well, that also appears to be a sort of justifiable resistance line where price has reacted against that resistance line and moved back down. The only difference is the starting point, whether you start it on the top of the wick here or a little bit lower down on this significant drop. Now, all of these starting points and placements of the line are valid. The only difference is that each line carries a different strength to it. So the greater the number of touches on these lines, the stronger the line becomes. In a fairly short correction like this, there's not enough time, there's not enough price action against that line to make any of them particularly strong and resilient. Eventually the price action will just break through them all in a bull market. But nevertheless, the sort of point remains that the strength of the line is determined by the number of successful times it turns price back down again. With all of that in mind, this afternoon I was looking at this chart and realised that this support line at the bottom is pretty clear and less open to debate than the top lines. So I just wondered if I set a support as a resistance line at the same angle, whether that would sit nicely on any of these candles. And hey presto, of course it does. There's an 18-degree line matching the bottom line that is stretching very nicely across the top of this candle here on the most recent price action. And if that's the valid resistance line to use, then what it implies is that price on the gold price hasn't broken out at all. It never broke out over the last couple of days. And that ties in nicely with the fact that silver hasn't broken out, neither has GDXJ, and neither has the Silver Junior Miners Index. I've remained cautious throughout the last couple of days because gold was the only chart that you could possibly argue might have broken out. All the others hadn't. Until the others do, there's no point being overly optimistic. So I think at one point I was sort of 40% in favour of an upwards move and 60% still favouring the downwards correction. Well, following today's price action, the odds have shifted in my mind to 30-70. Now that the candle is breaking below this bear flag, and if we get a close below this dotted line, which represents the bottom of the bear flag, then the odds will change to probably 2080 or 1090 in my mind anyway. So that's all good. That's how I see the gold chart at the moment. Anything you want to ask on that, Tom, before I move on?
No, I think you did a great job explaining the probability of each outcome and why you're seeing why you're really seeing those outcomes as more probable or less probable.
Yeah, and this is where my sort of background is in weather forecasting comes into it a little bit. You'll have people on your show, Tom, who are far more expert in the world of finance, economics, macroeconomics, and the details of money markets and all that kind of thing. My background and my experience is in weather forecasting and the use of modelling, specifically in weather forecasting and climate forecasting, and how the computer models gather evidence and how you build up an evidence base to support your theory. To my mind, there are a lot of differing opinions about gold and silver and cryptocurrencies and other markets, but none of that really matters much to me, because an opinion is an opinion that doesn't really mean much unless it's backed up by solid chart evidence, and it's only the chart that contains the truth of how the market is reacting to all the fundamental drivers. And if you try and weigh up all the fundamental factors behind why a stock should go up or why it should go down, you're going to very quickly get confused. It's much easier to analyze a chart and a simple breakout or a breakdown through a support resistance line than it is to try and work out the fundamentals of company the finances involved in individual companies. So if we move on to the silver chart, and this one's a lot simpler. Well,
just to add on that, Kevin, it always makes me think about the fundamentals. Certainly other conversations I have, for example, with Ted Butler, he's talking about how we could see JP Morgan not being short anymore and see the silver price explode soon. And it's hard to take all these things into consideration. And like you say, if we're focused on one thing at a time and making it a little more simple here, understanding the overall fundamental picture as well for gold and silver, which I think a lot of our listeners do, in a way it can give you a bit more conviction and ignore the day-to-day noise, right?
Yeah, absolutely. And even if you know the fundamentals and you know what's going on, there's a lot of sort of buy the rumor, sell the news kind of stuff going on. A lot of it's almost impossible to know what's priced in and what isn't priced in. How much is the stock market already discounting stimulus, for example? We all know that there are talks going on in the US around the next stimulus package. We don't know how big it's going to be. We don't know how much of that is already priced into markets. But what we do know is what's happening in front of our eyes on the price charts. And here's silver, for example. And if I were starting as an investor now and I hadn't got any investments in silver at all, I would see no reason at the moment to invest in silver until we get a confirmed breakout or breakdown. Now, this is a bear flag that between these two dotted lines rising in this sort of pattern like this is a bearish pattern. And when you've got you're coming up towards a resistance line like that, if price breaks down before it hits that resistance line or reacts negatively when it hits that resistance line, then that is a confirmed bear flag. If it continues on, then it becomes a rising channel, which then is, well, it's not bearish anymore because it's pushed through the resistance line, and it then becomes a rising channel which can break out to the upside. So at the moment, there's no strong argument just based on that chart alone as to whether the price would go up or down. All you know is that you're in an ongoing correction. So there's probably no reason to invest during an ongoing correction until you feel you've hit the bottom. Now, the target for me in this correction for silver, again, is time. As far as timing is concerned, it would be similar to the bottom for gold, if indeed it does occur sometime around about early November, as indicated in the gold chart, which would bring, we've had one leg down here, then a sideways consolidate, a rebound and sideways consolidation, another leg down, sort of a gradual upwards trend. I see one more leg down, which if and when this line is broken to the downside, is likely to be very rapid, because I think everybody's expecting it. You hear people saying, well, everyone's expecting silver to go down to $21 and gold to go to $1,800. So I think the opposite is going to happen. Well, the opposite might happen, but there's no evidence for that at the moment, and there's no reason to put your money in that position, because the charts are suggesting $21 silver, and if that were to happen, it wouldn't be unexpected. That would make it an intermediate cycle low. I think if you follow the cycle analysis guys, they're looking for the intermediate cycle low in gold and silver, and to be fair, they've been very consistent with this. And if this low here isn't the intermediate cycle low, then it means the next low is going to be below that, and that would imply that it comes down to the bottom trend line. There'd be quite a lot of panic at that point. And it wouldn't surprise me at all if there was a spike low that lasted less than a day that took it down to something, I don't know, could even go down to $19 and then reverse back to 21 and above. If it does get down to those levels, excuse me, if it does get down to those sort of levels, I would be buying very rapidly everything silver related I could get my hands on. So that's what I see sort of unfolding here. And that's how I see the silver chart, and it ties in quite nicely with the gold chart, I think. And
are you using the 200-day on that as well, Kev?
So yes, I was going to mention the moving average, wasn't I? If I go back to gold, and I zoom out, and get a wider view. Okay, so in fact, if I put the whole chart on, just ignore the annotations on the right-hand side because they're less relevant now. So here we go. We'll put the moving average back on. And I'll show you what I mean about finding a moving average that is going to support and add evidence to what it is you're looking for. So let me get the weekly chart on rather than. I suppose it doesn't really matter whether it's the daily or the weekly chart, but if you're looking at the 200-day moving average, that would be about 200 divided by 7. That's going to be about, just put that on for you, 60-day maybe, something like that. Let's have a look. And you just, as I said before, doesn't sound very technical or scientific, but you just sort of fiddle around with these moving averages until you find, there you go. So that's close to what you're looking for. And it depends a little bit where you think you are in the bull market. So if I zoom in a little bit, you can see that during the early stages of the bull market between 2000 and 2011, the 60, just put that on, so 60-week moving average this is, isn't it? Because that's a weekly chart. So the moving average here is supporting each price correction during the early stages of the bull market. You can see we had the correction in 2008 that came all the way down to here. And then afterwards, the moving average that was supporting price was different. So you can't just use one moving average throughout the bull market. You have to then, after this corrective period here, I would be looking at a different moving average supporting the price there. So as we're in the early stages of our sort of young bull market now, I would be looking at this blue line, this 60-week moving average, to be quite useful for supporting price. If I delete quite a lot of this stuff that's on here now, you'll be able to see, get rid of all of that. So the moving average is approaching $1,700, and as it rises over the coming sort of days and few weeks, you'll be getting closer towards sort of 1750, something like that. So that's why a spike down to that sort of level below 1800 is quite possible. This sort of dramatic drop that we saw in 2008 is the sort of thing that I'm expecting to see during the 8-year cycle low, which is due in 2023. So in 2023, somewhere around about here, I'm expecting to see a large correction that would pierce the 60-week moving average. Okay, and then price accelerates more rapidly. It makes sense if you think about it, that during the early stages of the bull market, you're building momentum. And then during the sort of final stage, the blow-off phase, as it's sometimes called, price accelerates away from the moving averages and becomes, well, parabolic right at the end here. It becomes a vertical line. So that's when you see that happening, you know that you're in the closing stages of your bull market. I mean, it went on for 2 or 3 years, didn't it, after this low here? So it can carry on for a couple of years with price accelerating away very, very rapidly. And you'd probably be looking at a moving average there, maybe, I don't know, 30 or 40 weeks. You'd have to fiddle around with the moving average, put in a different number, maybe try the 30, see if that's a bit closer. There you go. There's your 30-week moving average there, which supports the price. Maybe zoom in a little bit. You can see what I mean. And during that stage of the bull market, it's the 30-week moving average that's supportive. Yes, Tom.
I think that's another useful tool to really dial down the day-to-day noise and really reaffirm your conviction in that, right?
Yeah, and it's a reason not to be scared of using these charting tools on TradingView as well, because you listen to people like me talking on here. If you're fairly new to all of this and wanting to sort of get a handle on how to where to invest and how to invest and how to use these tools on here, it just shows that you don't really need to be a rocket scientist to sort of get some use out of these techniques, because you can literally do, well, I mean, all I did was just start fiddling around with all these weird and wonderful symbols on the left hand side until I sort of taught myself what they meant. And you go up here and you click on this funny function button, and it brings up a whole load of options, and you just click through them, and all of these are different indicators, and you don't even need to understand what the indicators mean. And I can show you what I mean by that by putting the stochastic maybe on here for you. If you put the stochastic indicator on, waiting for it to load up, there you go. And if I change from a weekly to a monthly chart, so instead of getting plotted points every week, you're getting plotted points on the chart at monthly intervals. Each candle is a monthly candle. So what you can see very clearly here is that during the bullish years, when price was rising substantially, the stochastic indicator remained in the top portion of its range, and you can sort of move the line down and read off the scale on the right hand side that somewhere around about 55 or 60 marks the low point for the stochastic indicator in this bull period. So as you come over to price action now, if we are indeed in a bull market, and if you're not convinced that we're in a bull market, this is one way you can convince yourself. You put the line here on the stochastic indicator, and what you need to see during any pullback and any correction is that the stochastic indicator does not go below that sort of level, because if it does, it's doing something that it didn't do during the previous bull run, and that would sort of make me cautious and make me sort of a little bit worried. So you need to look for reasons to be worried, and then keep testing them, keep an open mind, and keep testing your theory, because you could be wrong, I could be wrong, but as long as all of these factors remain on the correct side, if they all behave correctly, all these indicators behave correctly as you'd expect them to, then there's absolutely no reason to exit your positions, your long positions in the precious metals market.
And I think another piece to that is really to help build a framework around understanding this price action and basically remaining calm as long as you have an idea of what criteria you want to see from the chart as you're going forward through that bull, right?
Yeah, absolutely. It depends what type of investor you are as well, doesn't it, Tom? I mean, you could be investing by looking at the 5-day chart, and you could be, one of these day traders who's jumping in and out of trades every few minutes. If you've got time to monitor the charts, maybe you're managing your own investment funds, retirement funds. I'm trying to move this chart and it's not working. There we go. If you enjoy playing the markets and you're managing your own funds, then you can play around with these charts, and you can buy a breakout here, for example, and then when the chart begins to break down, you can sell the breakdown. You can make small gains and profits each time by putting on lots of trades, or if you're trading very large amounts of money, of course, then these small price movements can make significant sums of money each time. But for me, my whole purpose in investing in these markets is to enable me to, retire from work early, or earlier than I would otherwise have been able to do. So, I take my funds, invest them, and grow the capital, and grow it as much as possible over the next few years to help fund the sort of retirement that I want to have. So everyone's got different aims, different goals, different ambitions, but you can see from this chart here, by coincidence, that the 30-week moving average is sort of fairly close to where we might sort of see the bottom in gold. It's already supported price back here in May, and also here in November. Price very temporarily sort of penetrated that level during the sort of anomalous lows in March. before accelerating to the upside. So sometimes you're playing around with the charts and something like that sort of happens by coincidence. You notice that you've got a line on the chart there that has some significance. So it's all different pieces of evidence. So that's the gold and silver chart. Do we want to move on and have a little look at Bitcoin?
Yeah, absolutely. We've seen it rise quite a bit here in the last day or two. So we can tell us how it's panning out on the chart, Kev.
Yeah, so I've got a couple of Bitcoin charts here. This one is sort of zoomed into the price action since 2015, and I'm not the only one that's been sort of highlighting this sort of pattern or formation. It's a bullish pennant pattern that has a flag pole, if you want to call it that goes back to 2015. And you measure the height of the flag pole and add it to the breakout level. Very simple way of getting an initial sort of target for the breakout. And depending on whether you use the wicks on the candles or whether you use the line chart or how you define the precise bottom and the precise top here, you would project a target somewhere in the $28,000 to $30,000 range. Of course, initially, a milestone. There's a couple of milestones really. There's one coming up around about $14,000 or so, I think it is. When you look at the chart with all the candlesticks on it, there's a sort of a resistance zone, I think around 14,000 if my memory serves me, and then you've got the all-time highs. Again, depends whether you define it on a daily close, a weekly close, or a monthly close, but they're up around here, somewhere around or above 20,000. So there's a series of sort of levels there, if you like, where the price is likely to pause and build a sort of a smaller bullish pattern before then breaking out to the next significant level. But however you look at it, I think price is now sort of confirmed the significant breakout, and the sort of $12,000 level has been passed in the last day or so with conviction. We're now looking at this passing $13,000 and accelerating away to the upside. If I switch to my TradingView chart on Bitcoin here, this is the very sort of close-up price action. But if I zoom right out to the full time frame, you can see that's the monthly chart, which simplifies things quite a lot. You can see that this has happened before, and it's common across all the charts. It's common in the gold charts, the silver charts. It's a common chart pattern formation where you get these bullish pennants that sort of also build out a base because they're occurring at a cyclical low. It's sort of 2015 sort of time period is a cyclical low. Back here you've got sort of 2011, you've got a sort of cyclical low, and then 4 years later in 2019. So just eyeballing the chart, you've got something of a 4-year cycle going on in here: 2011, 2015, 2019. So of course, next one's going to be 2023, which, lo and behold, ties in with the 8-year cycle low for gold, doesn't it? Mm-hmm. So that concerns me. It concerns me what's going on out there in the real world, and it concerns me about what it is that's going to happen in the real world to cause a huge sort of pullback in crypto and in gold in the period leading up to the bottom in 2023. So sometime probably in 2022, something not nice is going to happen. So there's always something not nice going on, and certainly this year's had plenty of not nice things going on. But you get my point. I think something particularly bad financially and economically is on its way. But we've seen this arc build out. We're now pushing towards the top part of this arc. I've posted on Twitter these arc formations for Ethereum and Litecoin, and probably one or two others as well, which show some very optimistic targets. But again, it's what the chart tells us is going to happen. So we'll just follow it and see how it pans out and how it progresses. But so far, it's all panning out and progressing exactly as I sort of expect. You can see link here, for example, is one that's been performing very, very well and is up 12% today. And if I sort of zoom in a little bit on the price action here, you can see bullish chart patterns breaking to the upside. We've had a bullish descending expanding wedge and a bullish pennant then formed close to the breakout zone, classic bullish chart action. And now we're approaching what I've got as an initial target, $13 or $14 there. I think Litecoin, I've got the arc pattern shown on here. And I think this is one of the charts where I was saying I've got some very optimistic targets in some people's eyes. You have to forgive these labels. They do funny things when you change the time frames. But $400 by next summer, when we're only at sort of $55 now, sounds ridiculous. And I'll agree, it does sound ridiculous, but that's what the chart is telling me. So I'm going to just track that. Ethereum as well has a similar pattern, and this one doesn't have the arc formation on it, but if it did, it would show you somewhere around about $1,400 by, I guess, sometime around about next summer. And we're only at sort of 420 now, so you're talking about a tripling of the price for Ethereum within a space of 6 to 9 months, I suppose, something like that.
Wow.
So
and as you were saying in our conversation before we started recording here, Kev, you're only really trading based on or buying into a market based on what the chart is telling you, right? You're trading breakouts and breakdowns.
Absolutely. I try to stay very neutral with these charts. I've learned, what constitutes a bullish chart pattern and what constitutes a bearish chart pattern. Now, a bullish chart pattern can break to the downside. Just because it's a bullish chart pattern doesn't mean it can't break down. But when that happens, it morphs into a larger chart pattern, and the chances are you're probably in a cyclical decline of some sort. So if you are aware of the overriding cycle that's controlling price movement, then you have a large part of the jigsaw puzzle in your favor. What I mean by that is that knowing that we have a 16-year cycle for gold and that it bottomed in late 2015 helps you to sort of realize that we're not expecting the next cyclical low until 2030 or thereabouts. So that's when it's going to sort of reach a next major low point. Of course, you've got the 8-year cycle low between now and then, but the 16-year cycle should be carrying us up in a trending upwards direction until probably the late 2020s. So knowing that helps you anticipate whether the bullish patterns will be more reliable and break to the upside as they are doing at the moment, and as they are doing in the crypto space as well. You can see these bullish flags and pennants all breaking to the upside one after another, and it's very, very bullish when you get a consolidation just below a support or a resistance line like this. So when you see a consolidation just below a major level like that, it makes it gives you a lot more confidence that you're going to see a positive resolution and price is going to spike upwards. I mean, I could pick a completely random chart. No, let's have a little look, shall we? We'll pick. Okay, we'll pick one of the uranium. In fact, we've got one of the uranium miners here. We've got Cameco. Saved me sort of searching around. So we've got Cameco here, looking at the uranium space. And if I zoom right out on this, what you can see is that we had a very strong bullish rise from 2000 to around about 2007 that took us from a couple of dollars all the way up to over $50. And since then, what's been for bullish descending wedge pattern, we've had a breakout, which is great. Then price has come back and tested that breakout in a very strong fashion and formed a very unusual sort of expanding wedge formation, which I've got here zoomed in. And when you start to sort of spot and recognize these patterns, it stops you from panicking too much. We've got bullish descending wedge forming here, very close to the support line. Bit of a panic here as people were perhaps scared out of their positions, but we're reclaiming that support line now, just as the indicators are starting to show a bullish crossover. So this should move very steadily back towards the $17 level, which is, if you're investing now, that's more or less a 50% gain, and that's even before we start to see the major move taking place in the uranium market, where we see these huge patterns starting to play out to the upside. So knowing where you are in the overall cyclical sort of stage of the market gives you a really good head start with all of these, and with all of these individual mining charts, whether it's uranium charts or whether you're looking at gold charts, like, I don't know, we've got I Am Gold here, for example. And you can see, again here, chart patterns on the 1 year time scale. If I zoom in, you can sort of buy the breakout, see price topping. If you were so inclined and you felt that you made a decent profit up to this point in the move from sort of $4.50 or thereabouts up to sort of $7, take profits. You get a bearish crossover on the indicator and exit until you've seen an upside resolution to this consolidation. So at the moment, there's nothing to sort of be worried about on this chart. You can see the overall trend since the March lows has been upwards. So all of the charts, all of the sort of mining charts are sort of following similar patterns. We've got Yamana here, and again with a very sort of large arc formation, and this just goes to show how common they are, in individual mining charts as well. You don't have to be looking at the overall chart for gold. You can find these arc formations in the individual miners, and they form at, like I said, it's cyclical lows, and then the arc gradually sort of guides the price upwards, and you just look for a series of bullish chart patterns, and that's exactly what we've got here. And so we know that price can come back down and test the $7 level without giving us any concern, but as we're expecting the gold market to move upwards in coming weeks and months, it's one that I'm going to stay invested in, and just hold the position. And when we get back down here, if we get back down here, you can add to your positions. So it's all about building evidence, I think, Tom, and just sort of for me, it's a buy, hold, and add on weakness sort of strategy. So I'll get a core position and hold that position through to at least the 8 year cycle high, add on weakness any funds that I've got, and continue to see the profits grow, and then probably exit a lot of positions at the 8 year cycle high, ready to get back in around about 2024. So that's how I'm playing it at the moment anyway. So all looking good.
Perfect, Kev. Well, we appreciate you adding to our evidence, and always appreciate your look into the charts.
Yeah, good. Well, I'm glad that, hopefully people find this useful and helpful. Listen to everybody else's views and opinions, because they're all part of the bigger picture. And I just hope that people find these charts useful. And if they do, find me on Twitter and follow me, and just keep learning and keep following.
Absolutely. And we'll have your complicated Twitter handle linked to the video. And you can see it on some of the charts there. Thanks very much for your time today, Kev. Always great to have you.
Okay. Cheers, Tom. Thanks a lot.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.